Income tax 2020. Tax type or categories. Come in, relax with income tax 2020. When working at a tax firm or when doing your own taxes or when you're doing research or just discussing taxes with other individuals, you will often hear these broad categorizations. I'm going to call them broad categorizations of taxations. It's useful to know these broad categorizations of taxations so that you can discuss them, say, with clients at a CPA firm or with other individuals that you are working with at the tax firm or with other individuals, just discuss taxation in general. When we talk about categories of taxes, there's a couple different ways, of course. There's many different ways that we can break out the categorization of taxes. One is based on basically what the tax is taxing on. What are we taxing? How is the tax, in essence, being applied? So that would basically be, in our case, we're talking about income tax. Therefore, we're talking about the tax that's going to be imposed on income. Therefore, when people generate revenue, when people earn income, that's the point in time that the tax will be applied, as opposed to, say, a sales tax, which would be applied at the point in time a sale was made. So when something was purchased, the amount was applied at the point in time the sale was made at that point. So that's going to be like a consumption type of tax. We can also think about taxes in terms of these types of categories, which would be a flat tax, a progressive tax, and a regressive tax. And you'll often hear this type of categorization when people are discussing whether or not they believe a tax is fair or not. They'll try to put the tax into these categories to describe it. Is it a flat tax? Is it a progressive tax? Is it a regressive tax? And these will kind of give you these broad categories that will then typically go into more like political policy type of discussions in terms of whether or not the tax is an appropriate tax, a fair tax, and so on and so forth, which can be an interesting debate. And again, the more interesting the topics are, the more likely you are to understand them better as well. So it's good to have some understanding of these terms. So the categories that we're going to be discussing is a flat or or a proportional tax, and then a progressive tax and a regressive tax. So you're going to hear these terms oftentimes in debates. You'll hear them in political discussions. You'll hear politicians will throw out these terms often with regards to taxation. So if you're in the world of taxation, these terms will start to be kind of buzzwords that you will hear when they're being discussed in politics. So what is a flat or proportional tax? A flat or proportional tax is a tax rate remains the same over income levels. Therefore, as income goes up, we're going to apply the same tax rate. And if we apply it to income tax, we're applying it to the point in time that people earn revenue as people earn income. So if someone earned $10,000, for example, the flat tax, let's say it's at 10%, we have a flat rate at 10%, the rate doesn't change, the income level does. They would then be paying tax of $1,000. If we had then $100,000 and we apply the same flat 10% rate, they would have tax of $10,000. So note that the tax actually goes up, of course, as income goes up, which is a little counterintuitive because we often hear this in debate of comparing and contrasting to a progressive tax, which is what we actually use, at least on our income tax system. We use a progressive tax, and when you compare and contrast a progressive tax to a flat tax, the tendency is to say, well, because the rates actually go up in a progressive tax, as we'll talk about next time, we don't have a flat rate of 10%. And the tendency is to then jump to the conclusion that a flat tax must mean that people pay the same tax as their income goes up because it's not a progressive tax. But that's not the case. A flat tax, of course, still means that you're applying the flat rate as income goes up. Therefore, as people earn more money, they pay more taxes. It's just that they're not paying more taxes at an increasing rate, right? A progressive tax means that they're going to be paying more taxes at an increasing, the rate is going to go up as the income levels go up, which we'll talk about next time. Now, some of the benefits of a flat tax, again, this is not what we use basically in our income tax, but we kind of use it in some other areas. Also note that when we think about these kind of terms like a flat tax and a progressive tax, we often don't use like a pure flat tax, meaning we kind of throw in some little deviations to the flat tax. Like you might say that if someone earns $10,000, you're not going to be applying any tax at that level, which means you basically put in a level, which means you kind of put in a progressive type level to it, right? Because now you can have two rates, zero, and then another rate that will apply. But the lesser of those categories that you have, the more flat the tax is, because it's going to simplify the tax to some degree. So you might have some alterations to the tax, and you can discuss whether a tax is more progressive or less progressive. if it's a flatter tax compared to a more progressive type of tax as well. So, but in any case, you can take, for example, our income tax, like FICA tax, which is Social Security. These are kind of payroll taxes. These are the taxes taken out of someone's W-2, not for federal income tax purposes, but to pay Social Security and Medicare, our support kind of programs. And that's more based on kind of a flat method to some degree. So, for example, yeah, these are just examples here. If you had the 40,000 times, let's say the rate is 6.2% for FICA tax, for Social Security tax, let's say Social Security, that's going to be the 2,480. And then if you earned 100,000 times that 6.2%, then you're going to be having the 6,200. So once again, you can see on our, basically this type of tax acts in some regards like a flat tax. Now again, it's not completely flat. One difference with the payroll tax is it has a cap to it. And so again, there's limitations, or there's often like this concept of flat or progressive, and then we make adjustments to it, which kind of adjust the debate as to whether the tax is going to be fair or not fair. So we won't get into the debate on the cap or why there's a cap in payroll taxes. We have a payroll tax course if you want to get into that more, but you can just see the concept of as, of course, the income goes up, the tax goes up, even though the rate remains the same. Now, one of the major virtues of a flat tax is it's easy. So it's easy to calculate. So, and that makes it a really good for like business or planning type of purposes, because we want to be able to estimate into the future. I want to say, well, what if this happens into the future? What's my tax going to be? And if I just have one rate, that becomes very easy to do. So one of the downfalls then is, well, what if I want, you know, people that earn more to pay more, right? They want it to be more progressive than simply a flat tax. Well, then it's, you know, you can't add more, you can't really change it without making the tax system more complex, because you have to add levels of taxation then, which turns it from a flat tax to a progressive tax. So that's one thing that you can do, right? So then if we go to a progressive tax, we're typically adding a level of complexity. This is basically what our tax code is on here. We're basically using a progressive tax with the income tax code. And you can see now that I need this entire table to explain what the progressive tax is doing. So when we do when you do payroll taxes, all you really need to know is, well, how much did someone earn? You just multiply that times the tax rate. You know, it is what it is. But when you talk about the progressive tax for federal income taxes, then you need this huge table. Now, although this table is intimidating, it's not too bad when you do a tax preparation purposes, when you're actually doing the tax preparation, because you have software. And when you work with this in software, for example, this is our Excel worksheet that kind of shows the formula. When you work this in software, you might verify it basically using the worksheet over here and actually do the calculations in a worksheet, which is fairly basic or not too difficult oftentimes for a basic tax return, to get down to taxable income, basically the income side of things. Once you have the taxable income right here, then you can basically, you're going to be reliant on the software typically to some degree to then do the actual tax calculation on it, which will be somewhat complex, right? So oftentimes the tax preparer will kind of verify and check thoroughly the income statement side of things, and then rely fairly heavily on the tax return to apply the tax tables and to apply the progressive tax system. So the software makes it, you know, pretty manageable for us to actually do the tax preparation, even though this table is quite intimidating, letting the software do it. Where it becomes a problem, of course, is when we project into the future. If you're trying to figure out what they're going to owe in the future and run scenarios on what they're going to owe, how much should they be taking out of their wages so that they're paying the proper amount in the future, that becomes more difficult, because now you're doing projections into the future. And again, you kind of need software to do projections instead of what would be really easy to do projections if you only had a flat tax, right? So that's where the kind of confusing comes in. So basically what happens is you're going to need the filing status to know what the tax rates and levels will be. So single, married, filing, joint, head of household, and so on and so forth. And then you need the income levels. And then the income levels, now we have tax rates at these different tiers. So now we've got these different tiers, different rates. We don't have a flat tax. We don't have just one tax. We've got multiple taxes. So then let's concentrate just in on this column here. So we're going to concentrate on single filers. That'll be a little less burdensome to be taken a look at. And we're going to be looking at this and saying, okay, how are we going to calculate the tax? Again, we're going to use the software to do it typically, but how would the tax be calculated? Well, anything below this amount up to $9,875 is going to be taxed at the 10%. That's going to be taxable income is going to be taxed at the 10%. And notice we're talking once again about taxable income. So that's going to be the bottom line kind of like of our income calculation. So that's after we have the standard deduction or itemized deductions and the adjustments to income to get us down to the taxable income needs to be everything up to $9,875 will be at the 10%. Then the next level is from the $9,876 to $40,125 is at 12%. So when I get to this level of 12%, the confusing thing here is that I'm not just, for example, if I earned $40,000, which is going to be within this range, I'm not going to be taking 40,000 times 12%, but rather I have to take 9,875 times 10%, and then I've got to take the difference that gets me up to the 40,000, which would be 40,000 minus the 9,875, which would be 30,125 times the 10%. And then, well, let's do that again. It would be the 40,000 minus the 9,875. That would be the amount times the 10%, times the 10%. And then if I added that to the amount I got with the 12%, that would be the calculation. I've got these different tiers. So it's not a really easy type of calculation. As the income goes up, it gets more complex because now I have to calculate 10% on the amount up to 9,875 and 12% from 9,875 to 40,125, and then from the amount of income from 40,125 to 85,525, we would calculate up to 22%, and so on and so forth. So you can see it caps out down here at 37%, but again, remember that no one ever you don't actually pay 37%. So because you're paying a progressive tax system, so everything up to this amount, the 518,400 was paid less than the top rate of 37%. So this leads to a lot of distortion when people talk about this in terms of political terms now, because if you want to make the tax rates seem really high, then you're going to point out that the top rate is 37% and not mention the fact that people aren't actually paying the 37%. They're going to be paying the amounts, below that, and you'll hear comparisons of basically a progressive tax system to like a flat tax system, which would, they're basically disparaging a flat tax system as if a flat tax system results in people paying less taxes, which it doesn't. As income goes up, you still pay more taxes. It's just the rate of increase. So the complexity of a progressive tax system is what leads to a lot of distortion with regards to the debate, depending on in terms of should we have a more progressive or less progressive system because of that complexity. Notice you can also think in terms of how progressive is something. Something can be a more progressive system and a less progressive system. In other words, the more layers you have in this progressive system, the more progressive it is because the more complex it is. And again, it's not really a problem to make the taxes if you have software to do it, but when you're projecting out into the future or you're trying to think what will happen in the future, it becomes a burdensome calculation to make, to just kind of intuitively make or make fairly quickly without the use of software to do so. So you can see now, for example, if you were to say, okay, what if I took my flat tax and I said I'm gonna tax people at 10% if it's over a certain amount, and if they make less than a certain amount, I just will not tax them at all. So now we've kind of added a level of progressiveness. Now we have a progressive tax system, but a fairly basic 2-level progressive tax system, right? And then as you add levels of taxation, then your progressive tax system is getting more and more progressive could have virtues in that, it's going to tax more at the top. You can debate whether or not, the rates going up is going to be a good thing or a bad thing and whatnot. But the downfall for sure, or the problem with it, the drawback of it, is that it's going to add to complexity in terms of people being able to plan and understand what is actually happening. So there's often the debate in terms of how complex the tax calculation will be versus, the progressive nature or the benefits of having a progressive type of tax system. So then we have the term of regressive, so a regressive tax. So that's going to typically be obviously used in a negative type of way, because what a regressive tax is going to be saying is the tax rate decreases as the wage base increases, Now, that normally isn't the case, meaning as income, like for an income tax, it's not the case that the rate will typically go down, right? Because most times we're thinking that if people earn more, the rate should either be the same, flat tax, or should increase, progressive tax. But if the rate was actually to go down, that would be regressive. Or you might have a situation with a tax resulting in a larger percentage taken from the lower income earners. So that's probably the context that we would see it more often, meaning as we're not looking at the actual rate decreasing as people earn more, but we're looking at a situation where the lower earners are paying a higher percentage of their taxes, and that's when the regression term will typically be. Now, this will often be argued with something like a sales tax. So if you think about a sales tax, then you're thinking about something that's going to be taxed at the point in time that a sale is going to be made. And the reason people will typically label this as regressive, which will basically be a negative term for tax purposes. If someone's promoting a sales tax or any tax and someone else says, well, that's a regressive tax, they're basically, they're kind of calling the tax like a bad name in political terms, right? They're saying, you're bad, right? So they're going to say it's a regressive. And if it truly is regressive, then it could be a bad thing. But just note that for tax terms and in political terms would typically mean that the tax is going to be bad. Why would they call a sales tax a bad thing? Well, note that you might think at first glance, you'd say, well, people that earn more money are clearly going to pay more sales tax if we tax them at the point in time the sale is made because they buy more stuff. So if someone buys a yacht, if you're a billionaire and you buy a yacht, you're going to be taxed on sales tax at the point in time you buy the yacht. So that would still result in the people that have more money, the people that have more wealth would then be, when they spend that wealth, taxed more at that point in time. However, you can also argue that of course, people that don't earn as much, if you earn a lower income amount, you're spending all of your money on just the necessities, food, electricity, housing. And so all of your income is being spent, it's being consumed. And if you're taxed on all of your income being consumed, a higher percentage of your income is being taxed than if you have income that you could save. If you have the ability to save and you're not consuming, then you're being taxed possibly at a lower percentage of your income. So that's going to be the argument. Notice it's not really that clear oftentimes, however, because it's possible for wealthy people to actually spend more than they make. Sometimes they can actually be taxed on more than they earn, because if you inherited wealth, then of course you might be spending more money than you earn. And so you could be having a tax rate, that's higher in that degree. And also just note that it's often the case when countries apply a sales tax or a usage tax, such as Europe has a sales tax and usage tax, not an income tax, and they're typically thought of as a more progressive place oftentimes. What will happen, the way you fix that problem is you say, well, we're not going to apply a tax on the basic necessities. So then if you say, I'm going to take a sales tax and I'm going to remove the need to apply a sales tax to food and a sales tax possibly for rent, then now you have removed those necessities, the things that many people that are spending all of their money are spending it on, and therefore they're not being taxed. So you can see how you could take a normal tax and that could be regressive in nature and just make a few tweaks and alter it from a regressive tax possibly to something that's not a regressive tax. So these kind of categories are not as easy to fit things in as you would think. They're not like straight lines. There's more of a fuzzy line between them, and you got to be kind of careful when people start to put one thing in one category, one thing in another category. So basically, instead of having a flat tax, progressive tax, and a regressive tax, you really have a flatter type of tax usually, or a progressive tax, more progressive or less progressive depending on how many levels or tiers you have. And then you can start to argue whether those taxes are regressive or not regressive, more regressive or not regressive, and the lines are not as clearly drawn as they might be indicated when people are of course making an argument as to what they think would be best from a policy perspective.